Topic introduces the term structure of interest rates and explains the concepts of spot rates, par rates, and forward rates. The term structure describes the relationship between interest rates and maturities for debt securities of similar credit quality. Understanding this structure is fundamental in fixed income valuation because different cash flows are discounted using rates appropriate for their timing. Yield curves derived from spot, par, and forward rates provide insights into market expectations regarding inflation, economic growth, and future interest rate movements. Analysts use these curves extensively for bond pricing, risk management, relative value analysis, and interest rate forecasting within global fixed income markets. Spot rates are discount rates applied to single future cash flows occurring at specific maturities. A spot curve is constructed by plotting spot rates against maturities and represents the theoretical yields on zero-coupon bonds of varying terms. Because each cash flow from a coupon-paying bond occurs at a different point in time, accurate bond valuation requires discounting each payment using the corresponding spot rate. Spot rates are therefore considered the most precise rates for fixed income valuation. Analysts often derive spot curves through a process called bootstrapping, which uses observable prices of coupon bonds and zero-coupon instruments to estimate individual spot rates across maturities. Bond pricing using spot rates involves discounting each expected cash flow separately according to its maturity-specific discount rate. Coupon payments are discounted using shorter-term spot rates, while principal repayment is discounted using the longer-term spot rate corresponding to the bond's maturity date. The present values of all discounted cash flows are then summed to determine the bond's fair value. This method differs from traditional yield-to-maturity valuation because it recognizes that interest rates vary across maturities rather than assuming a single discount rate for all cash flows. Spot rate valuation therefore provides more accurate pricing, particularly when the yield curve is steeply sloped or irregular in shape. Par rates represent the coupon rates that would cause newly issued bonds to trade exactly at par value. A par curve is created by plotting these par yields across maturities. Because bonds priced at par have coupon rates equal to their yields to maturity, par curves are widely used as benchmark yield curves in bond markets. Par rates are derived from spot rates and therefore reflect the underlying term structure of interest rates. Analysts use par curves for pricing new bond issues, evaluating relative value opportunities, and comparing borrowing costs across different maturities and issuers within government and corporate fixed income markets. Forward rates are implied future interest rates derived from current spot rates. A forward curve plots these expected future borrowing or lending rates across maturities. For example, a 1-year forward rate beginning 2 years from today reflects the market-implied interest rate for borrowing over that future period. Forward rates can be calculated mathematically from spot rates and are important for evaluating future financing costs, interest rate expectations, and investment opportunities. Analysts use forward curves extensively in derivatives pricing, interest rate forecasting, and bond portfolio strategies because they provide insight into how markets currently price future economic and monetary conditions. The shape of yield curves provides valuable information about market expectations and economic conditions. A normal upward sloping curve indicates that longer maturities offer higher yields than shorter maturities, reflecting expectations of economic growth, inflation, or increased uncertainty over time. In this environment, forward rates are generally higher than spot rates, which in turn exceed par yields. An inverted yield curve occurs when short-term yields exceed long-term yields and is often interpreted as a signal of expected economic slowdown or declining future interest rates. Flat yield curves indicate little difference among maturities and often suggest economic transition or uncertainty regarding future monetary policy. The relationships among spot, par, and forward curves are essential for understanding fixed income valuation and interest rate dynamics. Spot rates serve as the foundation because they directly discount individual cash flows. Par yields are derived from spot rates and represent the coupon rates necessary for bonds to trade at par value. Forward rates are also derived mathematically from spot rates and reflect implied future interest rates. In upward sloping yield curve environments, forward rates are typically highest, followed by spot rates and then par rates. In inverted yield curve environments, the opposite relationship generally applies. Recognizing these interactions helps analysts interpret market expectations and evaluate interest rate risk effectively. Topic ultimately demonstrates the importance of term structure analysis in fixed income markets and portfolio management. Spot, par, and forward curves provide essential tools for valuing bonds, assessing relative value, forecasting interest rates, and measuring risk exposure. Changes in the term structure influence borrowing costs, investment returns, and monetary policy transmission across financial markets. Analysts and portfolio managers rely on these yield curves to construct investment strategies, hedge interest rate risk, and interpret evolving economic conditions. A strong understanding of term structure concepts is therefore fundamental for evaluating fixed income securities and making informed investment decisions within complex global bond markets.